Welcome back to Paladin Financial Talk. I am your host today, Ellie Robison, and I am joined by my co-host, Jack Ekholm. Hello, Jack. Good morning.
Hello.
Thanks for joining us here today.
I'm so excited for our conversation. I can't wait. I love taxes.
I know you do.
Oh, yeah.
And for our listeners out there who might not know who we are, I'm a financial advisor here at Paladin, and Jack is a official paraplanner, right? Like, is that your title?
Yeah. I primarily work with Jeff Foley's clients and assisting them and working to become an advisor myself.
You're still fully licensed. So
fully licensed and working on my CFP as well.
Yeah,
So
you're on
trying
your
to
way.
learn.
Yeah, me too. I am working on my CFP too, but studying is kind of a drag sometimes around the holidays.
Yeah. Oh, yeah. Yeah.
I've been procrastinating a little bit. How were your holidays?
They were great. All my family is local, so no traveling necessary for me. I got to see neighbors on Christmas Eve and then a bunch of family on Christmas Day.
I love that.
It's strong traditions. We keep them going. So it was awesome.
I was out in San Diego with my family. My parents and my little sister live out there. So
Yep.
It was very rainy, which is normal for Southern California in the wintertime. But our flight was canceled on Sunday due to a snowstorm here in Minnesota. And I'm like, oh, shucks. I just have to stay in Southern California for an extra day.
Yeah.
So it worked out. Do you have, now that we're going into 2026 here, I do want to ask, are you a financial resolutions guy? Or I should say just New Year's resolutions guy, not necessarily financial?
Not a huge New Year's resolutions guy. I have ongoing goals that I reevaluate on an ongoing basis. So this is a time of year I can take a look at them and see how I'm doing in terms of, am I on track to achieve them, make course corrections, whatever.
Yeah.
But it's nothing centered around this is a New Year's resolution exclusively.
Okay.
What about yourself?
I used to be a resolutions girl, and I at some point kind of shifted my mindset as to, and it was more so financial resolutions for myself way back in the day. And now it's like, as you evolve, you kind of get your stuff together. And I'm like, okay, I know what I'm doing now.
Mm-hmm.
And then I kind of shifted into having like annual themes for myself.
Okay.
So one year I was like, I really want to focus on being a better friend for people. And I that was kind of my quote unquote New Year's resolution. I've been simmering on what my theme will be for 2026. And I kept thinking, I'm like, is organization going to be my theme for 2026?
Interesting.
I always thought of myself as an organized person, but I think the last 6 months personally, and then just throwing work, the hectic, scheduling of work, I have lost a sense of my organizational skills. And I think I need to get back to that. I'm like, I
That's a good one.
to ground myself and just feel like,
that's a really good one. And I think New Year's resolutions too, there is definitely a value to your goals being, smart and you having the metrics related to it. Is it attainable? Do I have a time, base to it? But I think it's also helpful just to have in mind something you want to achieve for the new year. So like being a better friend, I don't think you put metrics around that. I don't know if you did.
No,
but at least having it in the back of your mind. And so you're making an effort throughout the year.
Yeah.
It's something you've planned it in your head.
Yeah, I like doing that. So if anyone wants to steal my idea of creating themes for yourself instead of hard goals that people sometimes forget 6 months into the year, go ahead and try that out. So.
Yeah, that's awesome.
Okay, Jack. Well, we are here today because we're going to focus on some more taxes this month in January.
Mm-hmm.
And I guess one thing, let me reword this. People are making decisions every single day that might impact their taxes regardless if they realize it or not, right? So today's episode, we're going to focus on tax decisions you didn't know you made.
I love it.
I think this will be fun to dive into it. And the reason why I thought of this topic is it had come up quite a bit in some client appointments recently where I'm like, I don't think you realize you just made this choice and now it's impacting your taxes.
Yep.
So that's kind of what inspired me here today. These choices feel personal or practical to people, whether it's marriage or side income or moving or investing, but it quietly shapes your tax bill for years.
Yep.
Essentially.
Yep. And those 4 that you mentioned that we'll talk about today, I think the theme of that will be taxes don't come later. The tax system is responding to your decisions in real time. So might not be a right or wrong to the decisions. I don't think people planning to get married, for most of them, taxes aren't a huge consideration, but at least being aware of the implications of decisions like that.
Correct. I like thinking of taxes as more of a shadow right? So it's attached to how you earn and how you live and how you structure your life. Taxes are something that don't just happen after you're living life, like it's happening as you are conducting your life.
Yep.
So I think our first topic of here today is going to be a big one, and I'll let you introduce it.
Yeah, let's jump right in. One of the biggest decisions that people make from a tax perspective, as you mentioned, often without realizing it, and that is marriage. So
Huge one.
What should people know about that?
I mean, no one's getting engaged thinking, will you marry me? And have you reviewed our new marginal tax brackets, right?
Right.
Like the moment you are married, the tax system is treating you as a unit, not two individuals anymore.
Yep.
So that can be beneficial for certain people, especially when one spouse is earning significantly more than the other. And the reason for that is the federal marginal tax brackets. It falls, 10%, 12%, 22, 24, 32% tax brackets for married couples filing joint, which are exactly twice as wide for those as single filers.
Mm-hmm.
So for couples with similar incomes falling in those brackets exclusively, their federal income tax will shake out to be similar to what it would be if they were both filing single.
Sure.
But as I mentioned, when one spouse earns significantly more than the other, let's say, one is a stay-at-home parent with some minimal part-time income and the other works full-time as the household's primary breadwinner, married filing joint will yield a lower federal income tax bill because those wider brackets allow for more of the breadwinning spouse's income that would otherwise fill up into those lower tax brackets twice as fast to fill into lower brackets and thus be taxed at lower rates.
Yep.
That felt a little wordy.
Yeah. Yep. So in general,
yes.
For a lot of people, if you have similar incomes as spouses getting married and they're not exorbitant incomes, most likely it'll shake out to be roughly the same or better if you're married filing jointly relative to, compared to the two of you filing separately. But
there you go.
That's not always the case.
Yes.
There is something called the marriage penalty. So if both spouses earn similar higher incomes, you can actually run into a situation where the combined taxes married filing jointly are higher than if both of them were to file single. So the reason for that, as you discussed, Ellie, married filing jointly relative to single, the 10, 12, 22, 24, and 32% brackets are exactly twice as wide for married filing jointly compared to single filers. But when we get into those higher brackets, the top two, 35 and 37%, that's not the case. So for example, let's say you have two people and each are earning 500,000 a year in taxable income. If they file single, none of that taxable income falls into the 37% bracket. But if they're filing jointly as a married couple, almost 250,000 of that will fall into the 37% bracket. So something to be aware of there.
Yeah.
If again, that's your situation where it's two spouses
high income
earning
earners,
high income.
both of them. Yeah.
Yep.
And so marriage impacts much more than just income tax too. Student loan repayment calculations. So your loan servicer uses your combined AGI or your adjusted gross income to calculate payments on an income driven repayment plan. So a large combined income would significantly raise your monthly bill. Eligibility for credits, deductions, and certain account contributions too. So, for example, the child tax credit for 2025, I know we're getting into 2026, but let's just, we haven't filed yet for 25.
Mhm.
Single income would be a phase out of between 200,000 to 243,000, while married filing joint would be 400 to 443,000.
Yep.
Traditional IRA contributions for 2025, they're looking at your modified adjusted gross income. So your MAGI sometimes is what I call it. I don't know if people say that.
I'm a magi.
Magi.
Guy.
Okay,
Yep.
I say MAGI. And I don't say that to clients. I usually just say it in my head.
Yeah.
So active participants who are in the workplace with plans. So single income would be a 79,000 to 89,000 income phase out, while married filing joint would be 126,000 to 146,000. So not double, right?
Right. Something to be aware of.
Yes. Roth IRA too for 2025. Single income would be a phase out of 150 to 165,000, while married filing joint is 236,000 to 246,000. So there's phase out numbers in there. Usually you got to dial that in with a tax professional, but that's what we're looking at when we're giving recommendations usually. capital gains exclusions when selling a home too. So Jack, I don't know if I told you this, but when I bought my house earlier this year, I found out the weekend that this man had put his house for sale. He
Yep.
was getting married that same weekend.
Okay.
And I gave it some thought. And just a couple weeks ago, I just realized I'm like, he just did the best thing he could for his tax purposes because he was a single man and he had bought this home 30 years ago. And so he would have had to owe capital gains tax as a single filer because there was more than $250,000 of appreciation in his primary home.
Okay.
But because he got married this year and he gets to, file in a different filing status for 2025, he is now exceeding that appreciation threshold. So when you are married filing joint, you have 500,000 of appreciation that is not calculated towards capital gains, if that makes sense. So let me here read this bullet point is if you've owned the home for at least 2 years in the last 5 years and it's been your principal residence for at least 2 years in the last 5 years, and it doesn't have to be the same 2 years, you don't have and you haven't had excluded gain on the sale of the principal residence within the last 2 years, you can exclude up to 250,000 for a single filer or 500,000 for a married filing joint. And both must satisfy the latter two tests there. So the previous owner of my house did a fantastic move for himself.
That's smart.
Just avoided some capital gains tax.
Yeah, no, that's huge. And going back to the phase out ranges you had mentioned earlier. So you mentioned like for the traditional IRA phase out for deductibility, for example, it's not exactly double the single compared to the married filing jointly. So it's possible if you're someone who's high income and you're phased out of being able to deduct your contribution as a single person, but you marry somebody who has minimal to no income, it's possible that could benefit you because now your contributions could be deductible. But on the other hand, if you were both at the bottom of that phase out range at the 79,000, so not getting phased out quite yet, but you get married and now you're combined, now both of you are phased out.
Yep.
So
correct.
Something to be aware of when you're considering getting married and how that's going to affect your account contribution eligibility.
Yeah.
So if you're married as of the last day of the tax year, we talked about married filing jointly. You can also elect to or to file separately. So that brings about a question that we hear a lot. What is married filing separately? Does that make sense for my situation? There are some rare situations where it actually is beneficial to elect to file separately while you're married. For example, if one of the spouses has a lot of medical expenses, for example, that's a deduction that's subject to an AGI floor. So only the medical expenses in excess of 7.5% of your adjusted gross income are deductible. So if you're, married to somebody with high income and you have a lot of medical expenses, it might make sense for you to file separately so you have a lower AGI that places that floor lower for you. So more of your medical expenses are deductible. That is a situation where it might make sense. You also mentioned the income-driven repayment plans for student loans. And if you file separately while you're married, it's only going to consider your income. So evaluate whether if you're going to file jointly, it's going to consider both of your incomes together combined, and that might bump up your monthly payment. So it might make sense to file separately to avoid that. Another thing people don't consider when you file jointly, you are jointly liable for any fraud that the IRS detects, any fines or penalties imposed upon you. So if you suspect that your spouse might be, for example, not reporting income or somehow falsifying their return, filing separately can protect you from that joint liability. So again, a rare situation, but it would make sense there as well. But I will say, Ellie, for the situations I've seen where clients are married filing separately, it's never been for one of these tactical reasons. Usually it's just because we keep the finances separate. We want to keep our taxes separate as well. And that's fair. It's your prerogative, but there are also significant downsides to the married filing separate filing status that can substantially increase your tax bill and your spouse's tax bill. And that's what's happened in every situation I've seen. So it's important to be aware of those.
I have a couple clients who intentionally file married filing separate because of student loans. They're high income earners and they also one has massive student loan debt. She's a doctor, right? So that was
Makes
an
sense.
occasion. But you're absolutely right, where I also see a lot of clients who filed married filing separately just because they think it makes sense for them, but they don't realize the repercussions that they're doing to themselves by doing so. You already talked a little bit about that, but I want to add on is if, for instance, if you are married filing separate and one spouse files itemized, the other one has to as well. I've caught that error in a client before where I was working with the wife and I'm like, your husband owns a business. He is itemizing his tax return. You need to get this amended. She didn't realize she was doing her tax return wrong. Also, the SALT deduction cap is lower if you are married filing separate. 40,000 is the cap for 2025, but if you were married filing separate, it's only 20,000. That's another one. Taxation for Social Security too. So if you're married filing separate, it's always 85% of it will be taxable to you.
Yep.
You're not going to have that range if you are married filing joint. What else is there? The child tax credit, qualified adoption expenses credit, and child credit for child and dependent care expenses are not always available to married filing separate too. The Roth IRA has a phase out of $10,000 of modified adjusted gross income. That's huge too. So we have some alternatives for our clients if they fall under that. Let's make sure that we still get some money into Roth. You just can't traditionally contribute to it the way that most people do. So, and I would say there's even more bullet points on top of that. But those are just some starting points. And usually when I am talking about taxes with clients like this, I also say, hey, I want a final confirmation from your CPA, right? I'm like, I think you should do this. This is my professional recommendation, but let's get one final, recommendation from your tax accountant and let's go from there.
Yep. And when we review clients' tax returns, we often see, and it's part of many tax preparers' softwares, where they will compare the ultimate tax bill if you were filing single, married filing joint, married filing separately, and advise you on what the optimal filing status would be.
Yeah.
So make sure to consult your tax preparer and have them run that sort of analysis if you're on the fence as to which way to go in terms of filing status.
Absolutely.
That's an important one. So another big one we see, Ellie, is side hustles. So could be freelancing, selling online, consulting, maybe even driving for services like Uber, DoorDash, Instacart, whatever. It may be 1099 income. You may know it as that, but you may not even get a 1099 for it. You might just be doing your own independent business work. Yeah. So people get into these, they have a desire for extra income, but there are additional implications to doing that kind of work and having that kind of income. So what should people know about that?
Well, you know what? The IRS looks at it as, congratulations, you're a business now.
Right.
So you are now dealing with self-employment tax as one. So you have to pay both employee and employer portions for Social Security and Medicare taxes when you're doing that. And it introduces Schedule SE into your tax return. You now should consider paying estimated quarterly taxes too.
Yep.
I have a couple people in my life that don't pay quarterly, and I say, please do that. Like, it will help your life if you do that. Which you may need to pay taxes throughout the year to avoid the underpayment penalty, which is why it's recommended to pay quarterly. So it helps avoid that penalty at the end of the year. And keeping of all of your income and expenses in case of an audit is something that you're going to have to do, and tracking deductions too for your tax return.
Yeah, and that brings up a good point. So if you are operating a business, that opens the door to deductions in the form of any ordinary, necessary, and reasonable expenses that you incur in the business with the intent to realize a profit or produce income from that. So it's kind of a double-edged sword. And so there's some considerations for you to think about there. First of all, there might be lots of additional expenses to operate your side hustle. So consider whether they're worth it. I think in general, there's a misconception and people go crazy for deductions. Keep in mind, you're spending $1 to save your marginal tax rate. So if you're in the 22% bracket and the 6.8% bracket on the state level, you're spending $1 and not having that dollar of income just to save the 29 cents on taxes. So it's important to keep that in mind. Are those additional expenses worth it? And then second, if they're worth it, are you willing to put in the time and effort to keep track of them to make sure that your tax return is correct and that you're taking advantage of all those deductions? Because if you miss the record keeping for it, you're going to miss the deduction as well.
Correct.
So there's a lot of work there.
It's a lot of work. And an important reminder is you're not getting additional deductions unlocked for yourself if you just form an LLC.
Not automatically.
No,
that's
and I think that's a huge misconception with a lot of people who are obsessed with starting a side hustle or having a small business is if the activity isn't generating profit too, the IRS may classify it as a hobby. Do you remember studying this in CFP?
Yes. The 3 out of 5 rule.
Yes. So which means expenses generally aren't deductible and losses can't be offset by other income. You have to have a generation of profit for 3 years out of 5 for it to be considered a business, and if not, the IRS is viewing it as a hobby.
Yep.
So you'd be filing Schedule 1 on your tax return instead of Schedule C.
Yep. So
if that were the case.
Good points there. Another one that we see is moving to a different state. So could be for a number of reasons, whether it's you're moving for a job or trying to be closer to family, seeking better weather, or a lifestyle in a different state. Those are all great and valid reasons, but there are tax implications from moving to a different state. So it is a tax decision to be aware of as well. So what should people be aware of on that front, Ellie?
Yeah, I mean, different states and even cities have different tax rules. And I do think it's very common for people to talk about the no income tax states out there. Like Florida is number one. You hear that all the time. But a couple other states would be Alaska. So if anyone wants to move to Alaska in retirement, go for it. Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming are the no income state taxes out there. But just for people to be aware of, there are I would say some tax retirement income. Excuse me. I'm wording this weird. Some states are allowed to tax retirement income differently. There we go. I couldn't get my words out. For example, 41 states do not tax Social Security, which is a lot of states.
Mm-hmm.
And for example, the state of Alabama allows your first $6,000 of distributions from retirement plans to be tax exempt for retirees 65 plus. I didn't know that. I was researching that and I was like, that is kind of a cool
really
rule.
interesting.
Mm-hmm.
Yeah, there's a lot of variation between states. And we also frequently see clients, they'll move to a different state or they do the 6 months in a day. So they're able to change their residence.
Correct.
And file in another state to get the benefit of that other state's tax structure. So you mentioned Florida. That's a really common one. People move to Texas or do the 6 months in a day there, Tennessee, wherever. And while there might be benefits there from a purely tax perspective, it's important to consider other things as well, whether it's the cost of living in that other state. And yes, they might have no state income tax, but they might have higher property taxes. They might have toll charges now when you're traveling on public roads.
Mm-hmm.
So consider whether uprooting your life, moving to another state where you might be away from friends and family or in a climate you don't prefer is worth the tax savings. We've had a lot of clients come to us and say, I want to move to Florida for the tax benefits, or we're moving to Tennessee for the tax benefits. And we look at their tax return and their current state tax bill is $1,500. Is it worth it for you to uproot your life and move to another state to save the $1,500 a year? And let's say it's even more than the $1,500. Is it going to be outweighed by a higher cost of living or more property taxes? Oftentimes we find it's either minimal or it shakes out to be pretty much net the same.
Yeah.
So other things to consider besides just the tax benefits of moving states there as well. But there are tax differences.
Yeah. With moving states, sometimes I think it's more of an emotional choice for most people. I think we can talk the numbers, to someone all day long and they're going to say, I don't care. I'm moving to Florida, like regardless, or I'm moving to Southern California. I don't care if I'm paying higher taxes.
Yes.
It's a little bit more of an emotional thing, but it's good for people to be aware of. Another point to this would be, it's not another point to this topic, but another brand new topic here. Here's one that surprises a lot of people is two investors can earn the same return and pay very different taxes on it.
Yes.
Which can ultimately eat your returns.
Yes, because it's not about what you earn exactly, but where, so in what accounts and how. So it's important to make the distinction between taxable, what we would call non-qualified, or you might know it as just a general brokerage account, versus the tax treatment of gains and dividends and interest in tax deferred accounts. So keep in mind, if you're investing in a just a general taxable brokerage account, you're going to be taxed each year on the interest, the dividends, and the capital gains that you realize. So if you have an account where you're doing frequent trading, it makes more sense for that to be in a tax deferred account like an IRA, a Roth IRA, a 401k, where each year you're not taxed on the gains that you're realizing when you're making those changes.
Mm-hmm.
Or if you have bonds, for example, that are kicking out a lot of interest, or high dividend paying stocks that are kicking out a lot of dividends each year, that's going to reduce your return in a taxable brokerage account if you're having them there, because you're going to get taxed each year. And the tax bill that you have on that's reducing your return. That's what we refer to as tax drag. So there are benefits to having non-qualified assets to be able to access. They're more liquid, especially before you reach 59 and a half and you're able to tap into those other accounts without penalty. But you have to balance that with what assets make sense in that account to ultimately reduce my tax drag and increase my overall asset return on my investment. So that's something we help our clients do, is that tax location optimization between accounts. And then consider, if you're making changes in the taxable brokerage account, those capital gains that you're realizing, they're taxed differently depending on how long you've held them at the point where you sell them. So there's a difference between long-term capital gains and short-term. So let's say I bought a stock for $50, I sell it at $100, so I have $50 of gain. That's what I'm taxed on. But if I've held that stock for a year and a day or more, so over a year, then I get the preferential long-term capital gains treatment on the federal level. So depending on my taxable income, that's either 0, 15, or 20%, versus if I've held it for a year or less, it's a short-term capital gain. And so it's treated as ordinary income and my tax brackets are applied to it. So it makes a lot of sense, and something that we help our, encourage our clients to do is hold on to things for more than a year in your taxable brokerage account to get that preferential tax treatment, especially if it's an asset that's at a gain position where you've earned money on it. There might be an argument otherwise if you have a loss on it, and we can make some tactical tax decisions there.
Lock in those
but
losses.
For the most part, holding things for at least a year and a day in those accounts.
Yeah. So when someone says, I'm selling this now because it feels right, you're locking in a tax outcome.
Right.
Yeah. So that's a good one to bring up and kind of break down for people, because I don't think it's a prominent one in most people's minds when they are day trading on them by themselves and not working with a professional.
Yep. The timing is important, and the location as well. So which assets you're putting in which accounts matters. It can matter just as much as selection. So which assets you're selecting, what stocks you're picking, what bonds you're picking, what ETFs or mutual funds, et cetera. And most people don't realize that until after the fact, and they're hit with a big tax bill and they don't understand why. They wish they would have known this prior.
Correct. So some takeaways from today is simple, I'd say, hopefully. We're already making tax decisions when you choose how you earn by side hustles or small business, income, where you live, so moving to another state, to get married, and whether to file jointly or separately with your spouse is going to be a big one there, and then how long and where you hold your investments.
Yeah. So overall, the question isn't whether taxes are involved. We know in most situations they're going to be, and they're responding to the decisions you're making in life every day. So it's just important to be aware of the tax implications of those decisions and be deciding intentionally. These are all things that we help our clients evaluate and optimize. So if you're in the midst of making one of these major decisions that we talked about today, or you're just looking to create an intentional tax plan and follow that with regard to these decisions and others, reach out to us. Our number is 651-842-8406, or you can visit our website, paladinfinancial.com, and we'd love to connect with you and explore how we could be of service to you.
Thanks, Jack, for that. So you mentioned, that we can help with the tax planning perspective, all of this, but we have also officially launched Paladin Tax Services to help on the filing side. So Jack and I were not filing your tax returns, clients, but we have some accountants that are now going to be helping our clients with that. So if you are of interest of using Paladin Tax Services for filing for your 2025 tax return, please email us at info@paladinfinancial.com that you are interested in our services, and you will hear from someone on our team about it. So thanks for joining us today on this episode, Jack, on Paladin Financial Talk. Listeners, be sure to subscribe and share the show. And I hope you enjoy your holiday season and have a fabulous start to your 2026 year. We'll see you next time.